Welcome back to another episode of Making Sense with me, John Napolitano. We're here to break down the big questions high net worth families face. You know, the ones your investment guy never talks about. No fluff, no finance 101, just straight talk to help you make smarter decisions and keep your wealth working as hard as you do. Let's get to it. Welcome to another edition of Making Sense. I'm John Napolitano. So today we're going to talk to people that own real estate, want to own real estate, should own real estate, could own real estate, and some of the really hit tax ways to kind of approach the idea of depreciation, deductions, tax benefit, and how that ties into your holistic financial plan. Because really, remember, that's what we're about here at Making Sense. It's teaching people that have assets and high net worth people how to kind of fully integrate all aspects of their financial life. I have a specialist with me today, and that is Ryan Foley, 22 years in the business of cost segregation with Cunningham and Associates. Ryan, how you doing today?
I'm doing good, John. How are you?
All right. So let me just start with the elephant in the room here, man. You spend your day working with a lot of accountants. Gee, that sounds like fun.
I'm an accountant in myself, so yeah, I think we're in the fun part of accounting where we're focusing in on helping folks reduce their overall tax liabilities as opposed to the finite debits and credits. So it's not a bad gig, John.
So the do-it-yourselfer or the guy that has a horrible accountant buys real estate and he's thinking he's depreciating it over how long? What's the normal useful life?
Yeah, so useful life, according to the IRS, is for residential property, it's 27 and a half years. For commercial, it'd be 39 years. So essentially, you take whatever you're paying for that property, divide it by that number, and that's your annual expense.
And you and I both know that there ain't a damn thing about that house or building that's going to last for 27 and a half or 39 years. Isn't that right?
That's right. I mean, short of maybe some structural components like a foundation or some of the heavier components, you're absolutely right. Most of the utilities, non-load bearing walls, things of that nature, it'll need to be replaced or updated within that time frame.
So the concept we're talking about is called cost segregation. Tell us the 50,000 foot view of what is cost segregation.
Yeah, John, I think you hit the nail on the head, right? So you're buying this asset, and you're depreciating it over a long period of time. And what cost segregation allows us to do is essentially take that really big single asset and break it down into smaller buckets. And then once it's broken down in those smaller asset categories, you're able to take advantage of the tax code to accelerate that depreciation, get a larger expense in the first 1 to 5 years, as opposed to waiting to that 39 year or 27 and a half year period. And what it really allows us to do, John, is it aligns our clients' cash flow as well, because we know you go to a bank, you're going to borrow money, you have to put some money down, and a lot of properties when you buy it, you're going to need to do some sort of upfit, right? There'll need to be some sort of improvement before moving in. So this gives the deductions that are a little bit more in line with the amount of cash that's required up front. So it's a really good tool to retain cash, offset some taxes, and build equity long-term through real estate.
Now, we won't get too technical into passive activity losses and all that stuff, but if we drift there later, that's just fine. So in essence, let's just play with like really low numbers. $1 million building. You buy a $1 million building, and we know that building is made up of a foundation, a roof, windows, doors, electric, plumbing, fixtures, blah, 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 blah. So in the cost segregation world, you actually segregate each of those assets and consider what's the useful life for those individually, class by class. Is that right?
Correct. So you can take a building, if it's a $1 million building, we'll say it's a residential property, roughly, 20 to 25% of that building can be pulled out of that long-term 27 and a half year category and brought down into a shorter life. And then in turn, again, passive and active, there's some other nuances here in the technical side, but you would have the ability to have expense items for that 20 to 25% in the year that you elect to do a cost segregation.
So let's say, staying with that example, that we have $250,000 worth of things inside your real estate that'll be eligible for a shorter depreciation cycle. Let me ask a little bit of a nerdy question, but most of our clients know what the Section 179 deduction is. Is that stuff eligible for 179?
Much of it is, yeah. So it could be eligible for 179. It could also be eligible for bonus depreciation, which is the same concept, just different code section.
Mhm.
Um, the challenge 179 is in place under current tax law. The challenge with cost segregation is that bonus depreciation is starting to phase out. So since 2022, in 2022, you could depreciate 100% of an item. In 23, 80%, 24, 60%. This year, 2025, it's 40%, 26, 20%, and 27, it phases out to zero.
Mhm.
Now, the challenge with 179 is you can't send yourself into a loss scenario. So you can drive your income down to zero within that classification, but bonus is great because you can actually create losses, which a lot of our clients want to enjoy. They want to offset other income. So the extension or improvement on that bonus depreciation will be critical to enhance the effectiveness moving forward.
And just for those non-tax nerds, so I don't lose you completely, Section 179 is that section of the code that allows you to write off personal property or items that are not brick and mortar over immediately in this year. What's the 179 limit this year? Is it 250 or
1.25 million.
oh, is that all, huh?
Yeah.
That's a
Again,
lot.
the challenge on that is that it can't drive your income below zero. So you're going to need income equal to or in excess of that amount to fully realize the benefit of a 179 deduction.
Yep.
Bonus depreciation would allow you to drive below the amount of income that you have. And that gets I'm sure we'll talk a little bit more about the active, passive, and real estate income and how to separate that, because there's a lot of misunderstandings surrounding that.
Well, in fact, then let's jump right on. Oh, before we jump on that, let me ask there. So of the 250, like what are we talking about in terms of useful life for normal depreciation? And bonus depreciation is optional, right? You don't have to take it.
You don't have to. Yeah, right. So generally 1 to 10 years, but normally 1 to 5. So it just depends on the asset classification. But we have some flexibility in terms of the buckets that we put it in. But most of the benefits of the cost segregation are realized within the first 5 years of deploying that strategy.
And how do you actually do a cost segregation study? I mean, you have
Yeah.
to mean like builders or engineers?
Yeah, really good question. So, a couple different options. One, if it's a new construction build, what we're able to do is use the engineering takeoffs provided by generally a general contractor or the engineering firm. Sometimes we also get into the mechanicals. It just depends on the complexity of the project. If it's a building in existence, we can do a takeoff or a modeling against a similar building combined with a site visit with a walkthrough. So it's essentially we're looking at the existing conditions, and then based on that, we're able to do a study modeled against a similar property.
And once you get that done,
Mhm.
there's options, right? You can either take the bonus or take the seg or not take the seg.
Correct. Yes, absolutely. So once you complete the study and you
Mhm.
have the revised depreciation schedules, you can then elect or not elect to take different accelerated depreciation bonus or 179. The other interesting thing that you can do with cost segregation is it doesn't need to be implemented or deployed in the year that you purchase the building. So we have a lot of clients with very diverse portfolios, and they elect to strategically deploy the cost segregations depending on their income levels. So they might do it. It might be a period of several years that they deploy different segregation studies.
That is really awesome. So that's the beginning of how does this tie into your overall tax plan, financial plan right there.
Mhm.
So talk to me about some of the creative ways you guys have worked with CPAs and clients that own real estate to help them plan better.
Yeah, I think that's a really good question. So the actual completion of the cost segregation is
Yeah.
I'm going to put it into a general commodity category, right? So there are options out there. A lot of folks, they get a cost segregation completed because they think that it's going to provide them with a lot of deductions. And what gets found out when there's not coordination with the tax professionals, the CPAs, is that it really depends on their income, right? And in the types of if they are a business owner or they're a high net worth individual, if it's part of an estate plan. So you really have to understand holistically what's going on in the taxpayer's world. So a couple key things that we want to look at. One, And I promise not to go too deep into active and passive, but an understanding of it is important. So active and passive income is important to understand because you can only offset active income with active losses. You can only offset passive income with passive losses. So that's probably the biggest misunderstanding when it comes to cost segregation, where hypothetically a taxpayer gets a cost segregation gun, goes to the CPA and says, hey, this is great. I bought this piece of investment property. I want to offset my income. And they say, ooh, that's passive losses. And you're a high net worth W-2 earner. That's all active income. They don't offset each other. So that they run into something called passive activity loss limitations. So that wonderful, huge expense bucket they thought they had no longer exists. They might be limited to, say, $25,000 in deductions, which might not even cover the cost of completing the study, right? So they end up in a backward situation because that whole process wasn't looked at. The other thing that's largely misunderstood is this concept of trying to get your passive losses, which might be a real estate investment, treated as active. That's often discussed as, I'm going to become a real estate professional. That's difficult to do. And candidly, if an individual has a business that they're running, a W-2 job, and they're investing in other real estate, it's difficult, if it was ever scrutinized, to actually solidify that they are a real estate professional. They need to meet certain hour requirements, the 750-hour requirements. There's all sorts of requirements that need to be met. But it's very, very difficult because they're not spending substantially all of their time in the real estate profession. So there's another pitfall there. But strategically, there are some opportunities. First of which, and this often gets overlooked, is if you are a business owner and you buy a piece of real estate that your business is going to operate within, there's an opportunity for you to elect what's called a grouping election, where you actually group your real estate that your business is housed under alongside or with your operating entity. And then everything is treated as active. And the benefit of that is you can then do a cost segregation on that building, and it would directly offset the active income that your operating entity is generating. That's a critical a critical strategy point that the grouping often gets overlooked. Never mind the cost segregation itself. So it's important to understand that relationship between those two entities.
So again, that holds true. Of course, we would recommend a client set up a separate LLC to own the real estate. You have your separate company or LLC that is operated there. Those are what you're going to then combine in order to get that real estate loss considered to be an active trader business as opposed to passive.
Absolutely. Absolutely. And that's very smart to set up a separate LLC for a variety of reasons. Legal protection. There's a lot of succession planning, exit planning, estate planning. So yes, you would make the grouping election at the LLC level and combine the income or have the same income treatment at both the operating entity and that real estate entity.
And I'm not looking to change topics, but I just want to send a quick word out to anyone watching. If you do own a business and you do own real estate and the real estate is inside the entity, go give your accountant a dope slap or ask why you haven't talked about, hey man, is there a way to fix this and how do we unwind this? But never mind, back to cost segregation. All right. Now, that's a really cool planning tip right there, that combining your active business along with the real estate. What else can we do for people?
Yeah, that's great. So I touched on the subject of trying to back into this real estate professional status. It's one of the most common questions we have with clients or people that are referred to us, and we started having those discussions. One of the things that often gets overlooked is trying to look at the situation differently. So as opposed to trying to have those real estate losses be treating as active, it's creating passive income that get actually that the passive losses can offset. And there's a variety of things that you can do, both, and you can speak better, John, to some of the investment opportunities within limited partnerships or things of that nature. But one of the common things that we talk to CPAs and our clients about is setting up things like family limited partnerships, right? Which they can fully control, and you can actually create a nice little family planning entity, do some estate planning, maybe some discounting, combined with creating some passive income, which they can strategically use to offset some of those passive losses.
I love that idea. Again, a really terrific idea. Now, bottom line though, creating these losses through depreciation or whatever we're doing, it's kind of temporary, right? Because at the end of the day, when you eventually sell the asset, you're still going to recover that as a reduction in basis, therefore an increase in gain and a little bit more tax than cap gains. Is that right?
Yeah. So what we often talk when it comes to cost segregation, it is a timing difference, right? So you're taking something from year 39 and you're pulling it to year one. So there's a couple factors that come to play. One, if this is a property that the client is looking to sell, 5 years is kind of the mark. 3 plus. It does depend on the planning. But if a client's looking to flip the property, we'll say there's some consideration maybe where you don't want to do it. But if the client's looking to hold it for a longer period of time, then you start combining in a net present value of the dollar today versus dollar in 39 years. The other thing that often comes up during conversations is, this is a property that I'm planning on keeping forever, right? It's going to be part of their estate. When it comes to estate planning, we want to try to drive that tax basis as low as possible, because when it's passed through the estate, the heirs, the beneficiary, actually get a step up in basis. So said differently, you want to get that tax basis low. Let's say it's $1 million property referenced earlier. Let's say when it passes through the estate, it's held for 25 plus years. Maybe the tax basis is $100,000. When it passes on to the next generation, it gets a mark to market value. So call it $2 million at that point in time. Then the beneficiaries can actually do a cost segregation again. So it's something often, right? Yeah. So it's a great estate planning tool.
So as the new bennies come in, even if it stays in the same LLC, but it's just a new step up in basis, they're going to get to do the cost seg clock all over again.
Mm-hmm. Exactly. The other thing some of our clients do is, if they know that they're going to be flipping the property or selling the property in a period of time, they can use a strategy called like-kind exchanges, where you take that property and reinvest it into a similar property. There's rules behind that. You have to use a third party to handle the cash, and you need to identify replacement properties within a certain amount of time. But the reality is, you can actually roll that tax basis into another property, which then may become a long-term property, so you can avoid or delay those taxes potentially indefinitely if it becomes part of the estate.
Mm-hmm. Well, I mean, that's got to be music to the ears of a lot of people. Many people think, oh, yeah, I'm just going to do an exchange called a 1031 exchange into something else. Not right. It's not that easy, and easily screwed up. Well, that's a good primer on cost segregation. Is there anything else, any tricks or common mistakes that you see when people try to do this?
Yeah, so I'd say just some general categories of folks. If business owners are looking at investing in real estate, there's a lot of opportunities, because generally, and this is just taxation in general, right? There's a lot of more opportunities with somebody who's operating a business, whether it's setting up family limited partnerships or investing in real estate that could be for business use, et cetera, et cetera. If you're a W-2 earner that just earns a lot and you're looking to diversify their portfolio, and you're looking at real estate, there are some options for them too. And it specifically falls under the short-term rental rules. So commonly referred to Airbnb, Verbo. So these vacation home rentals that are on average rented less than 7 days at a time, it can qualify as a short-term rental. If you qualify as a short-term rental, the real estate professional rules change, where you no longer need to meet the heavy requirements. You just need to provide substantially all of the services. And if you do that, you're able to claim the losses as active. So the short-term rental rules are very, very beneficial for folks that are high W-2 earners. And generally speaking, a role of a high W-2 earner that's investing in short-term rentals would be more of the coordinator, so the manager. Okay, so you're going to want to handle guest communication, coordinate vendors, probably do some repairs and general upkeep around the house. Normally, the limits on it would be hiring, say, a landscaper or site maintenance person and cleaners. If you go beyond that and hire a management company, then that management company starts to act in more of a role that you should be. So that's a delineation there, where if you do hire a management company, you may not be eligible. But if you're willing to work on the property, at least for a period of time, you can deploy a cost segregation, and it can be very beneficial. And there's no limit. You can have a number of short-term rental properties, and it will offset your active income.
Yeah, that's another great strategy that I hadn't heard much of being done before. People I know that do Airbnb type rentals aren't savvy enough to come understand that themselves. Hopefully, their accountants are keeping them apprised.
Mhm.
Um, and in the case of, let's call it as passive, let's go back to passive. You're the business. Um, you can kind of, I'm not going to say play with the rental income, but the example that I give is, you can drive down a street in, pick your city, USA, and on one side of the street is a Marriott. On the other side of the street is a Days Inn. The Days Inn is getting $100 a night. The Marriott's getting $300 a night. Both are
Mhm.
giving you a pillow, a bed, and air conditioning.
Mhm.
So if you own the business that your real estate's in, and the fair market rental rate is, let's just say, $20 a square foot, well, I suggest consider paying yourself 30. And the IRS can say, well, no, you can't do that. Fair market is 20. Well, that's not true, because we're going to provide concierge service to our tenant and include this and include that and include that. So that might be another way where we can kind of increase that passive income in order to offset the beautiful benefits of your cost segregation.
Absolutely. If you're adding passive services and able to receive income in that way, yeah, absolutely. You can do that, and it also, from a short term perspective, if you're actually providing those services as part of your offering, it actually adds more layers to your hours and involvement.
That's true. Yeah, that when did that 750-hour thing come into play? I remember
As long as I can remember.
yeah, in early days, I was around doing tax returns in 1986 when the passive activity rules actually came out, and when it first came out, it was pretty much just the substantially all requirement without
Mhm.
the hours, but, they'll come up with creative ways to make the taxpayer's life a little more difficult, I'm sure.
Mhm.
Okay, well, maybe as we wind down here, any last minute tips for those looking at it, and or a way to reach you, or where should they go? Someone's seeing this and going, man, we should be segregating out, the plumbing and all this other stuff in our building.
Yeah. So, at the end of the day, if an individual is owns real estate, operates a business, is looking for creative ways to lower their overall tax bills, have a conversation, right? And have a conversation with your CPA. Certainly, John and myself, we're resources as well. Feel free to reach out to me, and happy to take a look and have a conversation with you and talk about your case. And it really boils down to what's currently going on in your world, what your goals are, and then tying in a multi-year plan that you can understand and execute, and getting out of just the compliance cycle where it's always a year behind, or this is what you did. It's being armed with the information on how you can lower your taxes, and including that as part of your business and investment decisions. And that's where we see really the separation of folks that are leveraging the tax code as opposed to just benefiting.
Wonderful. That's really great advice. And before we started recording, I was lamenting about my millions of dollars in rent paid over the year. So if you're a long-term buyer or a long-term business owner, it really does make sense to own your real estate, but don't think of it as you're going to make a fortune on it. It's just money you're going to end up paying to yourself instead of someone else. Cost segregation is the way to go. Ryan Foley, you're awesome at this, buddy. I really appreciate you being here today.
Thanks, John. Appreciate the invite.
All right. And thanks to all you for watching this. Hey, send this off to some of your buddies that own businesses in real estate. I think they'll appreciate it. If you need further help, Ryan Foley's at Cunningham and Associates, and you know where to find me. Thanks for now. We'll see you next time. Thanks for tuning in to Making Sense. If you got something valuable out of today's episode, share it with someone who'll appreciate it. And don't forget to subscribe. One last thing. If you love the show, open your app and give the show a 5-star review. Until next time, thanks for listening to Making Sense.
The views expressed on this podcast represent the opinions of each speaker and are subject to change. These views are not intended as a forecast, a guarantee of future results, investment recommendation, or an offer to buy or sell any securities. The information provided is of a general nature and should not be construed as or used as a substitute for individualized investment, tax, financial, or legal advice or service to any person. Financial planning and investment advisory services are offered through U.S. Financial Advisors, a registered investment advisor. Certain representatives of U.S. Financial Advisors are also registered as representatives of Great Valley Advisor Group, a registered investment advisor. To learn more about Napier Financial, please check us out at napierfinancial.com.